It is a moment investors have been waiting for, and when it finally arrives, the reaction is not what anyone expected. The company at the very center of the artificial intelligence boom releases its latest earnings report. The numbers are staggering. Revenue has more than doubled compared to the same time last year. The company's leaders announce a forecast that shatters what experts on Wall Street had predicted. By every traditional measure of success, this is a perfect report. Yet when the stock market opens, something strange happens. Instead of soaring, the stock price barely moves. It ends the day almost exactly where it started. For anyone watching the market, this raises a confusing question. If this is what a massive victory looks like, what would a loss do? This reaction is not a sign that the company's technology is failing. It is actually a clear signal that the market has entered a completely new phase. It is the beginning of what analysts call the show me phase for artificial intelligence stocks. So what does the show me phase mean for the stocks you might be holding right now? To understand where the market is today, it helps to look back. The last couple of years have been dominated by raw potential. When generative AI burst onto the scene, the initial reaction from investors was pure excitement. It became a gold rush. During this phase, the market rewarded promise. If a company mentioned AI in an earnings call, its stock might jump. If a company was a supplier to the big players, it was scooped up by growth-hungry investors. The thinking was straightforward. This technology is going to change everything, so getting in early on any piece of it is the smart play. Nvidia, reporting quarter after quarter of mind-bending growth, became the ultimate symbol of this era. But markets are forward-looking machines. They constantly try to price in what will happen next. After a stock has already climbed to incredible heights based on future expectations, the game changes. Nvidia has now reported several of these blockbuster quarters. The surprise factor that once sent the stock rocketing upward has worn off. Now the numbers have to be perfect just to justify the price it already trades at. It is not that investors are suddenly pessimistic about AI. Their psychology has simply shifted. The phase of buying on pure narrative and potential is fading. It is being replaced by a demand for concrete proof. Investors are looking at these giant companies and asking tougher questions. Yes, revenue is growing, but are profit margins holding up? Yes, the forecast is strong, but can you keep this up for several more quarters? This new mindset creates the show me dynamic. The market is essentially telling these high-flying AI stocks that they need to show something truly extraordinary to impress anyone now. If the chipmakers are entering a tougher phase, where are investors supposed to look for the next big opportunity? This shift does not mean the AI trade is dead. Far from it. What is happening is an evolution. The easy money that lifted almost every stock with a vague connection to AI is likely over. Now, the focus is narrowing. Investors are becoming more selective, looking deeper into the ecosystem to find the companies that will turn this technological revolution into sustainable profits. They are asking, now that the infrastructure is being built, who is going to use it to make money? This line of thinking naturally leads away from hardware makers and toward the software layer. Think about previous technological shifts, like the move to cloud computing or the rise of the smartphone. In the early days, the companies making physical components saw huge growth. But over time, the real value and most consistent profits often flowed to the companies building the software and services that ran on that hardware. The same pattern is emerging with AI. The spotlight is beginning to shine on software companies integrating AI into their existing products. These companies have a direct line to customers and can charge them for new, AI-powered features. A graphic design platform that instantly generates images, a writing tool that drafts emails, a customer service software that powers intelligent chatbots. These are practical applications where AI creates immediate value. For an investor, a software company with a strong base of loyal customers has a huge advantage. They can simply add an AI feature and raise the price. This leads to higher revenue from the same group of users. The market wants to see which software companies can successfully do this. Another area quietly gaining attention is the less glamorous but absolutely essential part of the AI boom: memory and storage. AI models are insatiable consumers of data. They need vast amounts of high-performance memory to function. This is where companies that specialize in making memory chips, like Micron Technology, come into play. They supply the brains of the AI operation with the materials they need to remember everything. As AI moves from massive data centers out to everyday devices like laptops and smartphones, a concept called edge AI, the demand for this type of memory, could explode. For investors looking for the next wave of growth, these behind-the-scenes players are becoming increasingly interesting. With this shift towards software and memory, how does an everyday investor even begin to sort through the options? Navigating this new show-me phase requires a change in strategy. The days of blindly buying a stock just because it is connected to a hot trend are likely gone. This new environment demands a more disciplined approach. For someone holding AI-related stocks, it means focusing less on hype and more on actual numbers in financial reports. Another smart move is to think about diversification within the AI theme itself. Instead of placing all hopes on one or two giant chip designers, build a small basket of different types of companies. This could include one leading hardware maker, one promising software company integrating AI, and one essential component supplier like a memory manufacturer. This approach acknowledges that it is still difficult to predict the ultimate winners. Considering all this, does this mean the high-risk, high-reward days of AI investing are finished for good? It is a fair question. The image of a stock doubling overnight on a hint of AI news might become a rarer sight. That kind of explosive movement is typical of the earliest, most speculative phase of a new trend. But for the long-term investor, the transition to the show-me phase can actually be a healthy development. It tends to separate companies with real substance from those merely riding a wave of hype. Think of it as a natural sorting process. When the tide of easy money goes out, it reveals which companies have solid business models and which have been wearing concrete shoes. This phase also paves the way for the next wave of growth. The current giants of the tech world, the ones building massive data centers, are making it clear that their spending on AI infrastructure is not slowing down. They are planning for the long haul. This continued investment is the foundation that allows the rest of the ecosystem to grow. The market is sending a clear message that the blank check for future potential has been cashed. From now on, it is about performance. It is about seeing profits materialize on a spreadsheet, not just imagining them in a presentation. This should not be a cause for panic, but rather a call to pay closer attention. It is a time to review holdings in a portfolio. Ask the tough questions. Is this company just a story, or does it have earnings to back it up? Is its customer base growing? The answers will determine which stocks continue to climb. If this deeper look at the market shift was helpful, please take a second to like the video. It helps more people find it. And if staying updated on moves like this matters to you, hit that subscribe button so you do not miss what comes next. Also, feel free to share this with someone else who is watching their AI stocks. Thanks for watching, and good luck out there.